Hello and welcome. You're watching the Global Reset here on CNBC TV 18 Prime with me, Prashant Nair. This is the show where we try and analyze the shifts in the current world order, get you expert insights on geopolitics, economics, markets, and of course technology, which is such a big part of all of it now. On the show today, we will shortly be joined by Shreyash Devalkar, Head of Equity at Axis Mutual Fund, and Sivakumar, Head of Product and Corporate Strategy at the company. You know, the focus for that discussion is that old debate, India versus China, or now should we talk about India and China in terms of investments. But before I get to that, as always, let me just quickly wrap up some of the news flow which we've had since last evening. Starting off with the Gaza peace plan. That is showing signs of progress. Israel's Prime Minister Benjamin Netanyahu thanked the US President Donald Trump, Special Envoy Steve Witkoff and Jared Kushner, as Israel and the Palestinian militant group Hamas signed a US-brokered agreement for a ceasefire. Listen in.
We're at a momentous development in the last 2 years. We fought during these 2 years to achieve our war aims, and a central one of these war aims is to return the hostages, all of the hostages, the living and the dead. And we're about to achieve that goal. We couldn't have achieved it without the extraordinary help of President Trump and his team, Steve Witkoff and Jared Kushner. I want to personally thank both of you, Steve, Jared. It's been long hours. You put in your brains and your hearts, and we know that it's for the benefit of Israel and the United States, for the benefit of decent people everywhere, and for the benefit of these families who will finally get to be with their loved ones. And I want to thank you on their behalf as well, and on behalf of the people of Israel.
Well, in fact, our Prime Minister Narendra Modi held a phone conversation with US President Donald Trump, congratulating him on the success of the Gaza peace plan. The two leaders, by the way, as you can see on your screen, also reviewed the good progress achieved in trade negotiations and agreed to stay in close touch over the coming weeks. Remember, this is the second phone call between the two leaders in 3 weeks. Speaking of trade, US Treasury Secretary Scott Bessent, in an interview to Fox News, said that India is set to buy less Russian oil and more US crude oil in the coming months. Listen in.
We're doing a lot on Russia, but the real culprits here have been China and India in terms of buying Russian oil. They are keeping the Russian war machine going, and we put a 25% Russian oil tariff on India, and I think soon we're going to see a rebalancing where they're buying less Russian oil, more American oil, and if we were to do the same thing on China, I think the war would end quickly, but we need our NATO or European allies to join us. It's my strong belief that India is going to start rebalancing over the next few weeks and months, and we will see a diminishment of Russian oil in favor of U.S. oil.
Staying with trade relations, Prime Minister Narendra Modi met his British counterpart, UK Prime Minister Starmer, and held high-level bilateral talks in Bombay yesterday. Both nations announced a new £350 million defence deal. The agreement includes a government-to-government agreement on the supply of lightweight multi-role missile systems to enhance India's air defence capabilities. A joint statement on Modi-Starmer talks listed the plan to supply lightweight multi-role missile systems to the Indian military, besides an in-principle move to finalize an intergovernmental pact to jointly develop maritime electric propulsion systems for India's naval platforms. Okay, we'll slip into a quick commercial break here. As promised, we'll come back with, that topic of India versus China with regards to investments. Shreyash Devalkar, Head of Equity at Axis Mutual Fund, and Sivakumar, Head of Product and Corporate Strategy at Axis Mutual Fund, join in for that. Stay tuned. Welcome back. Over the past year, the tables have turned in Asian equities, with China and Hong Kong staging a sharp rebound, even as Indian markets have largely moved sideways. It's a reversal few anticipated, and it's forcing investors to reassess how they should view risk, valuations, and opportunity across Asia as well. Today, we're looking at this bigger sort of, debate, India versus China, or you can sort of frame it as India and China through the lens of a specific fund. I mean, there are lots of funds which invest in Chinese markets. This one, what we're talking about, is the Axis Greater China Equity Fund, a product that gives Indian investors exposure to China, Hong Kong, Taiwan through the Schroders flagship Greater China Fund. The idea is simple: to capture growth in companies driving China's next phase in AI, automation, healthcare, etc., even as, I mean, that economy transforms away from real estate and traditional manufacturing. Now, a quick short bit about the fund itself. The Axis Greater China Equity Fund of Fund is a vehicle that allows Indian investors to participate in China, Hong Kong, and Taiwan markets through, as I said, the Schroders flagship Greater China Fund. It's benchmarked to the MSCI Golden Dragon Index and aims to deliver long-term capital growth by tapping into the region's evolving equity landscape. The fund is managed by Schroders' long-standing Asia equities team, headed by Louis Zalot, with over 3 decades of investment experience. The portfolio has a clear tilt towards next-generation themes, from AI and automation to healthcare innovation. It seeks a balance between value and growth across the Greater China region. For Indian investors, this comes at a time when the Indian market has underperformed its Chinese peers, with valuations in China still below historical averages and foreign inflows turning supportive. The Axis Greater China Fund offers a domestic route to participate in that recovery while maintaining, of course, on-ground management through the Schroders team. Let's now, without further ado, let me go across to Shreyash Devalkar and R. Sivakumar. Gentlemen, great to have both of you here. Appreciate it very much. You know, I pulled up some numbers, Shreyas. Let me start with you. And I think they're pretty stark. So if you look at dollar returns, right? India, I mean, let's take last 1 year. Nifty is down 7.5%. Hang Seng is up 25%. Shanghai Composite is up 15%. Now, if you look at Shanghai from the lows in April this year, it's up 30%. Hang Seng is up 30% as well, but its low was made in January of this year. The real money, though, has been made in the tech space, right? The Hang Seng Tech Index is up 50% from its lows in January of 2025. And we'll put out some of the individual stocks as well. These are all dollar terms, just to kind of sort of have a fair comparison. The question, let me ask you the here and now question, Shreyas, first. Is bulk of this, in your opinion, is bulk of this outperformance, you know, because you got to look at where things will be 12 months from now. Past performance, as you say, is not indicative of future returns. What is your sense? Is the best behind?
First of all, to begin with, any international investment, whether it is China or Nasdaq or any other country, in my opinion, one should look at it as a asset allocation rather than trying to time all these things. If you see the Chinese returns, what we are seeing now, this is on the back of 2021, 17% decline, 2022, 2% decline, 2023, 17% decline, right? And then now this is what we are seeing in 2024 and 25. So there are cycles across the market, and definitely one should look at in that context that one should have an allocation to foreign equity. So our take is that yes, one should have an allocation to foreign equity, in which it can be partly in China or partly in Nasdaq. And that's how I would first of all look at it. Now, coming back to your specific question that how one should look at this rally, which is probably concentrated to fewer tech segments. And if you observe similar pattern, just I'm trying to draw a parallel with US. Similar pattern that yes, the growth is not there much at the economy level, while if you see the returns by the Nasdaq are totally different. In China as well, what we have observed that despite weak economy, so if you take all the macroeconomic parameter, that there has been subdued growth, there is a deflationary pressure, there is a housing market weakness which is there in the market, and the hope of fiscal stimulus have faded recently. So if you take a typical top-down view on a country, then most of these parameters, it may not stack up very well. But on the other hand, and that's where I'm just drawing the parallel with the Nasdaq versus S&P. Here, if you notice that despite this weak economy, there are beneficiaries of AI, companies which are working in AI, electric vehicle, and healthcare space. So this has been the strongest space where the companies are having globally competitive capabilities, and market has somehow rewarded them. Especially if you see this rally started post DeepSeek and that realization that yes, China is also having companies around that. So it's more to do with, as you're rightly highlighting, that few segment which is going to be the case in any, so to say, emerged or emerging or closer to emerged economy, which also happens in case of US.
Shreyas, over the last, you go back last 25 years, right? So China has been actually take it from say 99 when China opened up, and 99 was when they joined the WTO, right? And
Yes,
take from that point, it's been a fantastic growth story in terms of economic growth, but actually it's been a terrible market,
true.
right? So when you say it should be country allocation and not tactical in that sense, I mean, there's no comparison. I mean, I think our returns, dollar terms, 25 years is about 12, 13%. Whereas, I think China's far behind. So how should one look at this? I mean, there seems to be, as they say, strong growth does not translate to stronger stock prices. But we're talking about China specifically. So how do you respond to that?
So country allocation, when I mean that again, I would go back to the parallel between China, because most of us maybe would have seen in detail the US and the way their market has behaved. There as well, the tech-oriented companies have given return, and in China also so far in this rally, only that part has given much more return than the broader economy based companies. And that's where when I said that yes, it's a allocation, it's the international allocation what Indian investors. So if you see any other investors across globe, they have investment across multiple geographies, so it's not only restricted to particular country as such. And obviously India is the fastest growing country, so as an Indian investor we should have our highest exposure in it. Having
Yeah.
said, yes, a part of it, so it's that part can be 5%, 10% based on individual comfort, but part of it can be in a foreign equity, wherein you are not actually playing the economic growth. You are actually buying the best of the companies which are globally competitive, and that's how Nasdaq has given a return for us. And that's how some of these companies in China as well are also doing well.
Yeah, yeah. I mean, in US, of course, I mean, I know so many people who start investing early because, they want to send their kids abroad to US. So they want to keep the money there and all kinds of considerations, right? But no one sends kids to China. So China, in that sense, is about making, but it's done well. You're absolutely right. And actually, we'll put up stocks here and look at some of this stuff, right? Hua Hong, this is Hua Hong Semiconductor Limited, 260%. This is all part of the Hang Seng Tech Index, 260% from the lows in 2025. Horizon Robotics, 155%. Tencent, of course, we all know, 127%. JD Health, we all know, 123%. Alibaba, of course, 108%. If you look at the worst performers as well, even there, BYD is one of the worst performers. It's up 27%. Yeah, I mean, there are stocks down as well. Mutuan is down about 30% and so on and so forth. But I mean, this is the pack, the technology pack, which has done phenomenally well. And I guess this acknowledgement around the world that in many of the high-tech sectors, China is maybe at par or maybe only slightly behind the US, as has sort of, I guess, brought a lot of money back into that country. Mr. Sivakumar, you want to come in, your perspective on what we've discussed so far?
I think you've made some very important points here that don't just look at these because you have a view on a specific country or a specific market, right? So look at it from a perspective that if I were to build a portfolio, how much of my allocation should be at home in India and how much I should allocate to global stocks. Within that, you might find China interesting or you might find other products interesting. Why should it be restricted only to equities? It should be why can't we look at global, global alternates and so many other asset classes which come by the way. But I think let's now get to the specific question about China. Shreyash already mentioned this a moment ago, right? That when you had the large India rally 21 to 23, you did not have China participating. China underperformed massively, and there was a massive valuation gap between India and China. India had become very expensive and China was extraordinarily cheap. Today, we have had correction valuation here and Chinese stocks have rallied massively. Now, does does that make China expensive? That's an interesting question here. We've discussed performance, but question really is, has that performance already happened, or is there still performance in front of us? I think that's where we need to start having these conversations, right? One is about the macro asset allocation, but the second question is, where would you want to allocate? Are you going to an asset class which is still cheap enough? And what's really interesting is that despite the strong performance of Chinese stocks over the last almost 2 years, valuations in China are still just about or just above long-term averages in terms of, let's say, forward PE. Most of the stocks that you already discussed in that wonderful screen that you put up are still trading at multiples which are a fraction of similar companies like the Magnificent Seven, right? Those in terms of PE multiples. So the point here is that why we are discussing China is because you have similar stocks, similar sectors, similar growth, but valuations are still reasonably attractive. And that's the reason why we believe that there is still some amount of runway ahead of us in terms of performance. But China shouldn't be your only way to invest globally. You should look at having more diversified portfolio.
Yeah, no, 100%. Shreyas, when you invest here in India, do you see that, and since you have this fund, right, and you got access to what's happening in China, and you got teams there you speak to, I presume, regularly, there's lack of, and we've spoken about this on the channel as well, lack of AI and these kind of themes, right, robotics, and there are companies who are now established companies in, say, for example, the automotive space, which are tying up with robotics companies from outside, trying to do some of that here. But you don't have those, robotic native companies or AI native companies here so far. Maybe it'll happen. Is that a handicap from an India perspective? I mean, it's not that the market here can't do well because we don't have it, but what's your sense?
So as you are rightly highlighting that, yes, this rally, the way it started is with the acknowledgement of which are going to be the beneficiary of AI and who is at the cutting edge of usage of AI, robotics. Even actually partly it is also about biotech and pharmaceutical space.
Yeah.
Well, it is not only about this. So this rally has been actually on the back of all these three counts, in which if you see in India as well, it's not that we are not having the beneficiaries, but probably let's discussion if we restrict it to the listed space. And then in the listed space, definitely there are companies which are using AI, but the disproportionate beneficiary of those are not as far as of now are very much visible in the listed space, and that's where there is a difference per se. But if you see in India CDMO space, right? If you see last 1.5 year, the rating or the valuation or re-rating which has happened in this segment is actually in sync with that global trend of biotech. When it comes to only specific to AI and robotics, then yes, our industries are using it, but it's again about the disproportionate beneficiary and in the listed space. So some of the companies are still there in India, but then maybe you can count them actually on your fingertips.
Maybe we'll have tie-ups with Chinese companies, right, in some of these areas. And who knows? I mean, really, things are improving, at least on the mend. Yeah, sorry, Sivakumar, you want to come in?
I do want to come in here, and I think this is an important point that when you saw the last tech cycle 25 years ago, you had alluded to the 1999 peak of the market, right? And if you look at the extraordinary performance that equities have had since then, a lot of them have been beneficiaries of that tech cycle, but not necessarily the same companies which benefited in that rally. Meaning, at the first boom was the tech companies which created their technology, and the second boom was the companies which made use of that technology. So today you're seeing this, large move in tech companies which are at the heart of AI. I think there's a very good chance that as we go into the next 5-10 years, you will see companies, the users of AI becoming more and more important. I think so. As investors, we should be looking also at who are potential big disproportionate gainers when it comes to using AI and the new technologies that come our way.
I mean, in India, at least the consensus in my conversations across a range of companies is it's largely going to be on the application layer here in India, where maybe you'll find winners, etc. Even as that debate rages on in the US and elsewhere, especially actually in the US, not so much in China, where too much money is being spent without very defined ROIs and timeframes, etc. Well, I think it's an interesting chat which we should continue to have, and maybe if both of you have insights out of what's happening in China, and you want to maybe get the Chinese fund manager on as well, it'll be fantastic next time, and we can do that. So thank you very much, Shreyash and Sivakumar, for being here and talking us through what you're doing with that fund of fund as far as China and some of the other markets are concerned. Well, I think it's a wrap on this edition of the Global Reset. Thank you very much for staying with us. More coming up after a quick break.